The IRS just received a massive $80 billion injection of capital, and if you think that money was spent on hiring people to answer your phone calls faster, you are making a dangerously expensive mistake. A huge portion of that $80 billion went straight into the war room of the IRS. We are talking about advanced artificial intelligence, predictive data analytics, and automated enforcement systems that are active right now in 2026. This means the era of the slow, human audit is over, and if you're a small business owner, a freelancer, or a retiree, you are actually the primary target because the new AI system is designed to catch statistical outliers in the middle class. If you want to know the secret red flags that trigger the IRS new automated audit engine and how to protect your bank account from a 2026 forensic scan, you need to stay tuned for this full audit. Subscribe to Tax Hack Pro. We follow the money and the legislative shifts that the mainstream media refuses to explain in plain English. Hit that subscribe button now to ensure your return is audit-proof before the IRS finishes its next digital sweep. The curiosity you should have right now isn't just about if you'll be audited, but how the IRS new AI, known as the Discriminate Function or DIF Score, is grading your lifestyle against your tax return. In the old days, an auditor had to physically sit at a desk with a cup of coffee and manually flag a return. It was slow, human, and prone to error. But in 2026, the AI doesn't sleep. It doesn't ask if you did something illegal. It asks if you look different from everyone else in your lane. If your spending, your social media, and your tax return don't tell the same story, the machine will flag you for a correspondence audit before you even receive your refund. The IRS has spent years training these algorithms on millions of previous tax returns to understand exactly what a normal taxpayer looks like. In 2026, they aren't just looking at your 1040. They are looking at the digital footprint you leave every time you swipe a card, post a photo, or register a new asset. This is the era of forensic data enforcement, and if you aren't prepared, the technology that was supposed to make life easier is about to make your tax season a nightmare. Red flag number 1, the lifestyle versus paper discrepancy. This is the most common trap for the 2026 tax season. The IRS AI is now cross-referencing public data at an astronomical scale. They are looking at property records, car registrations, and even your credit card debt levels. If you report an income of $73,000, but the AI sees you paying a $3,000 mortgage, driving a luxury vehicle, and spending $1,500 a month at high-end restaurants, the math fails. The IRS system calculates a cost of living index for your specific zip code. If your reported after-tax income cannot cover your basic utilities and rent, the AI assumes you have unreported cash income. And yes, we can confirm that in 2026, the IRS is officially scraping social media data. If you are posting photos of a tropical vacation while claiming a business loss, the AI will bridge that gap and flag you for an audit. To stay ahead of this, you must subscribe to Tax Hack Pro so you can learn how to document your lifestyle correctly. The AI is specifically looking for economic reality. If your paper reality says you're struggling, but your digital reality shows you're thriving, the machine will trigger a flag that no human auditor would have caught 10 years ago. Red flag number 2, the home office square footage trap. Every entrepreneur wants the home office deduction, but the IRS is getting aggressive with Zillow data. They are now cross-referencing your property tax records with your deduction. If you claim that 60% of your 1,800 square foot house is an exclusive business space, the IRS knows you are likely lying. Unless you live in a closet, that ratio is a massive red flag. The IRS Home Office Audit algorithm looks at the total square footage listed in public real estate databases and compares it to the percentage you are writing off. Furthermore, if you have multiple LLCs, you cannot double-dip the same desk. The AI looks for unique, distinct spaces for each business. If the square footage doesn't add up, they will disqualify the entire deduction and hit you with a negligence penalty. Remember, for a home office to be deductible, it must be used regularly and exclusively for business. If the AI sees that your office is actually your dining room table based on the layout of your home's floor plan, you are in the line of fire. Red flag number 3. The G-Wagon and Section 179 abuse. The internet is full of gurus telling you to buy a heavy SUV and write the whole thing off with Section 179 or bonus depreciation. While this is a legitimate tax hack, the IRS is looking for the single car anomaly. If you only own one vehicle and you claim 100% business use, the IRS will laugh at you. They will ask, do you never drive to the grocery store? Do you never drive your kids to school? If you don't have a contemporaneous mileage log, meaning a log you kept as it happened, not an Excel sheet you faked 6 months later, they will disqualify the depreciation. You will owe the tax back plus interest. In 2026, the IRS is using telematics data and registration records to see how many vehicles are in your household. If the ratio of drivers to cars suggests that your business vehicle is actually the family's primary mode of transport, the AI will trigger a manual review. Use a mileage tracking app to build your audit shield every single day. Red flag number 4. The Hobby Loss Rule, Section 183. Losing money in year 1 is a business. Losing money for 5 years straight is a hobby in the eyes of the IRS. Under Section 183, if you aren't showing a clear path to profit, the IRS will reclassify your business as a hobby. This is a disaster because they will go back 3 years, reverse all your deductions, and demand the tax back with heavy penalties. To bulletproof yourself, you need separate bank accounts, a formal business plan, and active marketing. You have to prove that you intended to make a profit, even if the market was against you. The IRS AI is specifically looking for lifestyle businesses, things like horse breeding, photography, or craft selling that look like a personal passion rather than a commercial enterprise. If you aren't generating a profit in at least 3 of the last 5 years, the profit presumption vanishes, and the burden of proof shifts entirely onto you to show why the IRS shouldn't gut your deductions. Red flag number 5. The steak dinner and 50% limit trap meals are a massive target in 2026. The rule is ordinary and necessary, and currently, client meetings are only 50% deductible. If you're making $60,000 a year but claiming $12,000 in business meals, the AI will flag you instantly. That is 20% of your gross income spent on eating out. If the IRS sees charges at 7-Eleven, Starbucks, and local pizza shops every Friday night, they know it isn't a business meeting. Without the names of the clients and the specific business purpose documented on every receipt, you lose the deduction in an audit. The AI is now sophisticated enough to categorize your spending by merchant type. If it sees a high frequency of fast food or grocery charges being labeled as business meals, it will lower your DIF score until you hit the threshold for an automatic letter. Red flag number 6. The short-term rental STR loophole. The STR loophole is the hottest strategy for W-2 earners right now because it allows you to use real estate depreciation to offset your high salary. If your average rental period is 7 days or less, you can treat it as non-passive income, but only if you materially participate. The IRS is now checking your time math. If you work 60 hours a week as a surgeon and claim you spent 500 hours managing one airbnb, the AI will flag the impossibility of those hours. They will check your messages with cleaning crews and your travel logs. If you can't prove the material participation, your massive write-off will be reclassified as passive and your tax bill will skyrocket. If you want to use this tax hack, you must subscribe to Tax Hack Pro. We are auditing the 2026 IRS algorithms to keep you on the right side of the law while keeping more of your money. The IRS is specifically looking for professional investors who are trying to skirt the passive loss rules by gaming the short-term rental definitions. Red flag number 7. The vacation masquerade. The IRS is onto the 2-hour conference trick. If you go to Hawaii for a 7-day trip but only attend a 2-hour business seminar, you cannot write off the whole trip. The IRS looks at the ratio of business days to personal days. International travel rules are even stricter. The AI specifically scans for high-ticket travel to resort destinations. If you don't have a clean itinerary, proof of meetings, and emails showing a business purpose for the majority of the trip, the IRS will treat the entire expense as a personal vacation. Your airfare, your hotel, and your meals will all be disqualified. In 2026, the IRS is also looking at your credit card, merchant category codes to see if your business trip was spent at theme parks or luxury spas. If the primary purpose of the trip wasn't business, the tax code says the travel is non-deductible. Red flag number 8. The round number syndrome. Nothing triggers the IRS AI faster than a tax return full of round numbers. If your supplies are exactly $500, your travel is exactly $2,000, and your utilities are exactly $1,200, the machine knows you are guessing. Real business expenses are messy. They end in cents and irregular numbers. Round numbers suggest that you didn't look at your bank statements and are simply making up figures to lower your tax bill. This is an invitation for the IRS to dig into every single transaction you made for the last 3 years. The AI is programmed to look for statistical improbability. It knows that a true set of business expenses follows Benford's law, a mathematical pattern of digit distribution. If your numbers don't follow that pattern, the machine knows they are fabricated. Plus one. Red flag number 9. the self-employment disconnect if you are a freelancer or gig worker, and the income reported on your 1099K or 1099 NEC doesn't match the gross receipts on your Schedule C, the system will flag you instantly. In 2026, the IRS has perfect visibility into third-party payment apps. If you took $20,000 in payments via Venmo or Zelle, but only reported $15,000, the unmatched data flag will trigger a correspondence audit within weeks. The machine is designed to reconcile every dollar reported by a third party against your personal return. If there is even a $500 discrepancy, the AI will assume there is more hidden income and begin a forensic sweep of your accounts. Red flag number 10, the 2026 credit abuse filter. With the expansion of various green energy and R&D credits in 2026, the IRS has built a new credit abuse filter. This AI module compares the size of your claimed tax credits against your business revenue and industry standards. If a small consulting firm is claiming a massive clean energy credit that exceeds their total tax liability, the AI will pause the refund. They are looking for credit mills that promise taxpayers big refunds by qualifying them for credits they don't actually deserve. If you're using a specialist who takes a percentage of your refund as their fee, you are likely being lured into an audit trap. The 2026 IRS is not focused on catching every single criminal. They are focused on probability of error. They are using $80 billion of tech to find the people who are statistically loud. The safest position you can take is to maintain clean records, separate your personal and business accounts, and ensure your deductions are logical for your industry. Consistency is your greatest defense against a machine that only looks for anomalies. The machine is looking for patterns, not people. If you can show that your business operates within the standard deviation of your industry and that every dollar is accounted for with a receipt or a log, you become invisible to the AI. But the moment you try to get creative with round numbers, excessive home office space, or 100% business use of a personal vehicle, you become a statistical outlier. Don't let the AI audit take your hard-earned money. Stay sharp, document everything in real time, and make sure your lifestyle matches the paper you send to the government. If you are unsure about a deduction, the smell test still applies. If it sounds too good to be true, the IRS AI will think so too. This is Tax Hack Pro, and we are auditing the 2026 IRS reset until your wealth is fully protected. Our mission is to give you the forensic tools to stand up to the most advanced tax enforcement system in history. I'll see you in the next investigation, where we expose the new side hustle reporting rules that are hitting in April and how they will change the way you use P2P apps forever. Stay vigilant, stay documented, and keep more of what you earn.